Welcome back to the deep dive. Today we are cracking open the playbook of one of Asia's most successful and maybe most media-shy modern titans, Duan Yongping.
That's right.
We are doing a custom deep dive into really the condensed wisdom he's put together over 30 years. It covers everything from concentrated value investing to, building these massive, enduring companies.
It's a huge scope. And for those who might not be familiar, he is the quiet powerhouse behind names you definitely know, like Subor, BBK Electronics.
And the modern smartphone giants OPPO and Vivo.
Exactly.
Yeah.
But what I think makes his philosophy so unique is how he transitioned. He went from actively managing these multi-billion-dollar companies to becoming this intensely focused world-class value investor. People often call him the Chinese Buffett.
Yeah, and we've pulled together insights from just a huge stack of sources. We're talking 3 decades of his rare interviews, public talks, and these deep, sometimes really elusive forum posts.
Yeah.
So this isn't just a list of quotes. We're trying to build like a systematic architecture of his success.
Our mission today is pretty targeted. We're not just looking for isolated principles. We want to connect the dots. We want to give you the shortcut to these nuggets of knowledge.
The core logic.
The core logic, the thing that let him build and exit these huge businesses, and then apply that exact same philosophy to investments in companies like NetEase, Apple, and Pinduoduo. We've broken it all down into 4 areas: investment methods, investment cases, business wisdom, and personal conduct.
It really sounds like a fully integrated philosophy. Okay, so before we unpack all of this, just a quick word that this deep dive is strictly for educational purposes. It does not constitute investment advice.
Absolutely not.
We're just exploring the thinking process of a master strategist, not, giving you stock recommendations.
For sure. We encourage you to think critically and do your own due diligence as you listen. And, for those interested in tracking the total market temperature, which is a concept he definitely follows, we did see a recommendation in the source material.
Yep.
You can search and download the iOS app Buffett Indicator from the Apple App Store. It's a pretty useful tool for just kind of measuring market frothiness. Helps you stay rational when other people are panicking.
Okay, let's unpack this core philosophy then. We have to start with the foundation of his investment method. And it seems like it's all built on the teachings of the Oracle of Omaha. Okay, so Duan Yongping he's crystal clear that the single most fundamental lesson he learned, the one that defines his whole career as an investor, was about perspective.
Right.
It's this simple, but I think profoundly difficult idea of buying a business, not a stock.
Correct. And the core revelation is, like you said, it's deceptively simple, but it is so hard to stick to when you're under pressure. He actually told this story about sharing his conviction with Warren Buffett.
Oh, really?
Yeah, he said, when you buy a stock, you're buying a piece of the company. And Buffett's reply was that this was exactly the lesson he learned from his teacher, Benjamin Graham, and that it had totally changed his life. So you're seeing this lineage of value philosophy from Graham to Buffett to DYP.
So that shift in perspective, it means you stop caring about all the market noise, right? It forces you to define value on your own terms. But how does he do that? How does he define it rigorously without, just guessing?
For him, value is, it's strictly mathematical and theoretical. It's the discounted present value of a company's future cash flow.
Okay.
So it's a future-focused calculation, but it's grounded in today's numbers. And your decision to invest has to be based on the stock being cheap relative to the value you calculate, in your heart.
In your heart, right.
That internal gut check of what the future cash flow is worth. It's not about whether it's cheap compared to last month's price. That's the key difference.
That discipline really separates value investing from just, speculating on price momentum.
It does. And it requires immense confidence in your ability to actually understand the business, which leads to this wonderful, almost Zen-like test he has for business quality.
The clarity test.
Yeah, the clarity test. He argues that good companies, you can describe them clearly in one sentence. Think about it. Microsoft is clear. Intel is clear. Google is clear.
You get it instantly.
Instantly. You know what they sell and how they make money? Bad companies, on the other hand, they need pages of explanation, complex diagrams, and you still walk away kind of confused.
So that simple clarity is the hallmark of a sound business model. It makes it easier to project that critical future cash flow.
Exactly. If the business model is muddy, the future cash flow is, well, it's uncalculatable. And therefore, for him, it's not an investment.
Right.
And that clarity leads him to his ultimate insight on ownership, which I think is maybe the most profound nugget in his whole toolkit,
which is
the concept of the ultimate buyer.
Okay, explain that, because that sounds like it totally reframes the market.
It does. He says that all stocks have only one true inevitable buyer, the company itself.
The company itself.
It eventually buys back its own shares through the compounding of its earnings, whether it's through, explicit stock buybacks or dividends. When a great company generates so much profit that it's just swimming in cash, he uses Mutai as an example, it's eventually forced to either distribute that money or buy back its shares.
So in the end, the company's own profitability is what realizes the value for you as a shareholder. You don't need some other person in the market to come along and validate the price.
You got it. The company validates its own worth through its own health. And that realization, it protects you from irrational markets. If you buy a great company cheaply and the market ignores it for 5 years, you don't panic.
Because you know the value is still growing internally.
Exactly. The cash pile is getting so large that management is eventually compelled to return it, realizing the value you saw years earlier. The market can do whatever it wants. The company's internal health is the only thing that really matters.
That sets a really strong foundation.
Yeah.
Okay, so moving from defining value to managing risk, we get to his golden rule. It sounds like standard Buffett advice, but he frames it in a very specific way.
The golden rule is simple. Don't lose money.
Rule number 1.
Rule number 1.
Yeah.
This is the primary goal, always. It's more important than returns. He stresses that the most important thing isn't maximizing your gains or catching every opportunity. It's about protecting your capacity to play the game.
Because opportunities are always out there.
They're always present, but your ability to grab them is gone if you suffer a catastrophic loss. If you lose half your capital, you need a 100% return just to get back to zero. That sets you back decades.
And this ties into his distinction between doing the right things and doing things right. I think this is where the real nuance is.
It's the core of his whole framework. Doing the right things are the foundational principles, the non-negotiables.
Like what?
Things like don't invest in things you don't understand, don't short sell, and crucially, never borrow money. These are the rules that protect the entire structure from collapsing.
And doing things right.
That's the execution level. That's where errors are just inevitable. For example, you might overlook some small detail in a good stock and lose 10% on that one position. That's an execution error.
Annoying, but not fatal.
Exactly. As long as you stick to the foundational principles, the right things, those execution mistakes won't ruin your life or your portfolio.
Let's focus on that never borrowing rule, the absolute ban on margin or leverage. Why is that so fundamental for him?
It all comes down to control. If you invest based on value, you're making a long-term, rational judgment about future cash flow. You plan to hold for years.
Right.
But the moment you borrow money, you are now dictated by price fluctuations, not value. A huge, irrational short-term market swing can trigger a margin call.
And that forces you to sell.
It forces you to liquidate a perfectly good, undervalued stock at the worst possible time, locking in a catastrophic loss.
So leverage doesn't just increase your potential returns, it completely changes the game. It forces you to abandon your long-term value perspective.
Precisely. It takes away your power to be patient. You're turning an investment into a speculation dictated by price and timing. For him, that's just an absolute moral failure in value investing. You lose the ability to just sit still.
So what does he do when he has cash but no immediate targets? How does he handle that, that state of inertia?
He buys short-term government bonds. It's boring. It's maybe even a little painful with inflation.
Yeah.
But it serves two vital purposes. First, it prevents large losses. It protects the capital. Second, and this is the most important part, it ensures you have immediate liquidity for when a truly cheap, valuable opportunity finally shows up.
You have to be ready to pounce when the market panics.
You have to. And on the flip side, if you have targets but no cash, you just have to do nothing. Patience is the only answer.
That level of patience must be torture in a bull market when everyone is bragging about their returns, which leads right into his views on concentration versus diversification.
Yeah, he's an unapologetic advocate for concentration.
Yeah.
He sees it as the only logical outcome of doing deep research.
And he's pretty critical of diversification.
Very critical.
Yeah.
He calls it wealth management, not true investing. He dismisses it as throwing pepper. Yeah, just scattering your funds around, hoping you'll grow with the market. It's basically admitting you don't know which companies are really superior.
Okay, but I have to challenge this. Concentration is a huge risk. If you put 80% of your net worth into 2 or 3 stocks, and one of them gets hit by some unforeseen crisis, political, regulatory, whatever, you could be wiped out. Yeah. Isn't diversification safer for, a normal person?
That's a fair challenge, and his response is all about his process.
But
he argues that if you have done the deep work, the valuation, the cultural assessment, the competitive analysis, and you genuinely believe one company, let's say Apple, is the single best investment idea available in the whole world,
then why would you only put a small fraction of your capital there?
Exactly. Why put the rest in 9 other companies you admit are not good enough to be your top pick?
It's an internal consistency argument. Your capital has to reflect your conviction.
Precisely. He's managing for maximized returns from superior understanding. His risk management comes from avoiding the big mistakes, like leverage, not from spreading his bets thinly.
And he also puts a very real human limit on this concentration.
He's very self-aware about his own capacity. He admires Buffett and Munger, who might handle a dozen stocks, but he admits his own capacity is way more limited.
Just 2 or 3 companies.
Typically, 2 or 3 companies at a time that he can understand with deep, continuous, high conviction. He said he tried managing 10, 20 stocks early on and found it was impossible to keep up with the research.
You just can't maintain that level of conviction if you're spread too thin.
You can't. And he's also a full positionist. He doesn't like holding cash.
Right, he finds it psychologically uncomfortable.
Yeah, especially with low interest rates. You're effectively losing money to inflation. His goal is to be fully invested what he thinks are the best opportunities, even if that means his portfolio is basically just 2 or 3 major holdings.
So he's not trying to hit home runs every day. He's playing the long game with his best ideas, which requires, I guess, a very specific mindset. Let's get into that. Time, price, and attitude.
This is where psychology really meets value. For him, long-term holding isn't a strategy in itself. It's the consequence of buying something below its intrinsic value.
You just hold it until the price catches up.
Or until a fundamentally better opportunity comes along.
Yeah.
You always have to calculate opportunity cost. But based on his experience, he says the market typically takes about 3 years to reflect the stock's true underlying value.
Okay, and this brings us to what you called the ultimate litmus test for an investor. How do you react when the price drops?
This is the definitive difference between an investor and a speculator. It's a brilliant insight. A true investor is fundamentally happy when the price drops.
Happy.
Yes, assuming the business fundamentals haven't changed. Because now they can buy more of that good business at a cheaper price, if they have the cash. They chase the value down.
Whereas a speculator panics.
A speculator panics. They see the price drop, they assume something is wrong, and they rush to sell, often at a loss. Speculators chase the price up, and they panic when it goes down.
That joy in a price decline is so counterintuitive. It's hard for most people who just see their paper gains disappearing.
It requires a total separation of price from value in your mind. And speaking of price, he has strong words for people who try to make money with technical analysis.
Chart reading.
Yeah. He calls them iron leaks, basically destined to be harvested by the market, always buying high and selling low based on emotion and flawed signals. His defense against all that is just to not move, don't panic.
It's almost a behavioral arbitrage strategy. He's exploiting the panic of the iron leaks.
That's a great way to put it. He's buying when they're selling. But what's interesting is that even with all this discipline, he and Buffett both admitted to having separate personal accounts for, short-term trading.
Yeah, that detail stood out. It's like even the most disciplined investors need to have a little fun.
For sure. But they keep it completely separate. They treat it like a hobby, like low-stakes entertainment. It almost reinforces the discipline needed for their serious money.
All right, let's move into the real-world application of all this. Let's look at some of his biggest hits and his current market views. We have to start with net ease.
Yes.
That's a legendary trade. It perfectly illustrates buying cash at a massive discount.
The net ease case is pure textbook value analysis. This was during a period of huge market turmoil. He bought net ease when the stock was around 80 cents a share.
Okay.
But here's the critical number. The book cash value of the company, the actual money in the bank minus liabilities, was $2.30 per share.
So wait, he was literally buying $2.30 of confirmed assets for 80 cents.
That's the margin of safety. It was enormous.
It's a no-brainer.
It was an easy, rational judgment. He looked at their products, which were games, and the leadership team, and he concluded they were prudent and weren't going to just burn through that cash. He wasn't relying on some complex future projection. He was just buying current cash at a huge discount because of public panic.
The panic created the opportunity, and his principles let him act on it. So what happened?
He bought a full, highly concentrated position. And the market, it quickly corrected its irrationality. The stock went up 20 times over the next 6 months.
Wow.
It was a total validation of his belief. But his only regret, he said, was that if he had truly understood net ease completely, he should have just bought the whole company.
Yeah.
Which implies, even on your biggest wins, there's always more conviction you could have had.
And he also used his investment in Yahoo as kind of a Trojan horse for another big success.
That's right. He said his investment in Yahoo was fundamentally an indirect investment in Alibaba. He saw the real value was in Yahoo's massive stake in the Chinese e-commerce giant, not in Yahoo's own business.
Okay, let's move to Apple. This is his most famous, his most enduring holding. And he made a statement to Buffett and Munger that must have raised some eyebrows.
Oh, for sure.
He said Apple's business model was superior to Coca-Cola's.
Yes, and this is where his background as a product guy really informs his investment thesis. He told the masters of value investing that Apple's model was just plain better.
How? I mean, Coke has the ultimate brand moat, selling a cheap, ubiquitous product for decades.
It all comes down to pricing power and ecosystem loyalty. He pointed out that people often buy Coke or Pepsi interchangeably. The decision is often based on price or just what's available.
Sure.
But for a true Apple user, someone in the iPhone, Mac ecosystem, if you compare the price difference between a new iPhone and a premium Android phone, the user's response is basically, who cares about the extra few $100s?
The loyalty is inelastic.
It is.
Yeah.
The ecosystem lock-in, the recurring service revenue, the brand, it all lets Apple charge a huge premium and maintain high margins without losing its core customers. That's pricing power way beyond what a beverage can command.
And he also admired their culture.
Deeply. He described Apple's culture as user-oriented, not business-oriented, which aligns perfectly with his own Ben Fenn philosophy. They're obsessed with making things well.
Right, even if it means missing a short-term trend.
Precisely. They have a strong North Star. He noted that Apple won't launch a product unless it provides enough value to the user, even if it might be popular or profitable in the short term. That commitment to quality protects the premium pricing.
And when he bought Apple back around 2011, he says the big shift in its revenue was already visible.
He said the transition where Apple would move towards getting half his profit from services and software, not just hardware, was already very clear. He famously said it was visible like an elephant nearby.
No complex prediction needed.
No. His own decades in the mobile industry helped him see that long-term, predictable revenue stream immediately.
Okay, moving from Silicon Valley to Beijing, another core holding is Mutai, a famous Chinese liquor maker. This seems to defy the fast pace of his tech investments.
Mutai represents something different. It represents stability, quality, and institutional inertia. He values it precisely because its core product, the production standards for the 53-degree flying ferry, must not change.
So the biggest threat would be a new CEO messing with the formula.
Exactly. Changing the flavor or the process to get a little more yield or margin would destroy the brand.
But that seems like a risk with a state-owned enterprise, an SOE. Management can change with political cycles.
True. But he sees a paradoxical benefit in the SOE structure here, that bureaucracy, which is often criticized, actually makes it incredibly difficult for any one person to change the fundamental rules and quality standards.
So the inertia is a feature, not a bug.
In this case, yes. It ensures long-term consistency and protects the brand's value over decades.
And he dismisses the idea that younger generations won't drink traditional baijiu.
He does. He reasons that, older generations are living longer and will keep consuming it, and younger people might pick it up later in life.
Yeah.
But regardless, alcohol, especially a luxury brand like Mutai, carries immense emotional value and status. That ensures stable demand.
Okay, let's pivot to his views on the current landscape. What's his take on the massive AI wave? Is it a bubble?
He's pretty clear on this. He calls the underlying tech an industrial revolution, not a bubble. But he immediately adds that bubbles always accompany revolutions.
So both things can be true.
Right. He says right now, every dog and cat claiming to do AI sees its stock go up. But he sees AI itself as fundamentally transformative because of the integration applications. It's not just a quantitative change, it's a jump of like 100 or 10,000 orders of magnitude in what's possible.
And that perspective informs his view on the chip makers.
For sure. He greatly admires Jensen Huang, the CEO of NVIDIA, for his long-term vision in building the CUA ecosystem. He says NVIDIA has built such a dominant position that they dictate terms. Meanwhile, he characterizes AMD's position as, I'll give you chips in stock, please use me.
That's a big difference in market leverage.
Huge. And everyone is now trying to break NVIDIA's dominance, which is fueling this intense chip arms race. And in that race, he sees a company like TSMC as just unavoidable.
Because they make the advanced chips for everyone.
They do. They've outcompeted rivals like Samsung and Intel in foundry services, making them this crucial, high-margin bottleneck in the whole AI revolution.
Now, Tesla and Elon Musk, this is a fascinating conflict for a rational investor. You have this undeniable business success driven by a personality he openly dislikes.
This is a critical case study in how his personal philosophy overrides pure financial math. He readily acknowledges Musk is brilliant. He cites SpaceX and Starlink, calling the reusable rocket landing too awesome. But he personally dislikes Musk's character and public conduct. He said he just doesn't want to be friends with him, even if it meant making money.
And that aversion actually led to a financial mistake. How does a disciplined investor justify letting personal feelings dictate selling a stock that went on to do so well?
It's not just feelings. It's a calculation of long-term risk and personal integrity. He sold his Tesla stock and admitted later it was a financial mistake. But he sold because of dissatisfaction with the service and, primarily, Musk's behavior. For DYP, the conduct of the founder is an existential business risk.
So it's not personal, it's a risk metric.
Exactly. He believes the EV business is tough, low differentiation. Tesla succeeded because of its differentiation. But ultimately, he decided the founder's conduct made the investment personally untenable and just too unpredictable long-term.
It elevates the character of the leadership to a fundamental risk factor right alongside the balance sheet.
It does. If the CEO is fundamentally unpredictable or ethically problematic, for him, that's an existential failure no matter what the quarterly results look like.
Okay, finally, Google.
Right. Buffett didn't buy it because he thought it was too expensive. Duan Yongping likes Google, but expresses a very modern concern: the extent to which its search business will be cannibalized by generative AI like ChatGPT.
A real threat.
A very real threat. If the core business structure changes, the whole value calculation changes. But even with that risk, he still bought some recently, which suggests he sees a deep margin of safety.
So just how concentrated is this portfolio? We hear about Buffett's 20 punches.
His is way more extreme. He estimates he's made fewer than 10 major punches, major concentrated investments in his entire career. His core holdings are basically just Apple, Tencent, and Mutai. It's a portfolio built for deep understanding and high conviction.
So his investment success is clearly a reflection of his decades spent building empires. Let's connect those business principles to his investment philosophy, starting with the goal that comes before all others: survival.
Survival is absolutely paramount. He states it really emphatically. The most important thing in running a business is survival. Development is secondary.
And development can only be built on a foundation of security.
Safe development, he called it. If you focus too much on speed and aggressive growth, you risk annihilation. And that is just an unacceptable existential error.
So speed isn't a virtue in itself. Growth has to be calibrated.
Perfectly. He calls it the minimum adequate speed. A business has to grow, because if it stalls for too long, employee morale suffers, the whole ecosystem deteriorates. But, and this is the key growth that risks safety is never justified, he completely rejects that Silicon Valley culture of move fast and break things.
That sounds exactly like his investment rule of avoiding leverage. It's a philosophy of crisis avoidance, not crisis management.
That is the critical link. His business and investment philosophies are identical. Think about his driving analogy.
The car heading for a wall.
Right. If you're driving 200 kilometers per hour toward a wall, it's already too late to react. The most important thing is not driving too fast in the first place. Crisis management is often futile. Crisis avoidance is the superior strategy. And that translates directly to the financial mandate: never use leverage.
This philosophy of slow, principled growth must come from the core culture he built at BBK. Let's talk about his two foundational cultural pillars, Benfin and Pingchengqing.
He believes corporate culture is inseparable from the founder's character.
Right.
You build it by hiring people who already agree with that worldview. And it evolves by defining what you won't do, the stop doing lists.
Okay, let's break down Benfin first. The simple translation is what? Integrity, duty. What does it mean in a business context?
It's a dense term. On one hand, yes, it's rooted in honesty and integrity. But operationally, it means playing the basic move, like in the game of Go. You focus on what you are supposed to do, and you earn the money you should earn.
So it's a rejection of shortcuts.
Completely. It's a rejection of chasing speculative trends or getting unethical gains just to pump up short-term results. If you operate with Benfin, you're building a reputation, an intangible asset that lets you survive market turmoil.
And the second principle, Pingchengqing.
Pingchengqing means ordinary heart or rationality. It's about extremely rational conduct. It's actively avoiding cultural elements that encourage excessive ambition, grandiosity, or the relentless pursuit of great achievements. It's a cultural dampener on ego.
It sounds like a rejection of the hero CEO complex.
Exactly. It promotes steady, predictable management. If you're guided by an ordinary heart, you're less likely to panic when the market crashes or get reckless when you succeed. It prevents management from making that 200-kilometer-per-hour mistake.
And this emphasis on honesty leads to his view of integrity as the greatest defense against failure.
He calls integrity the biggest filter. He believes it's a necessary condition for long-term development. But crucially, he says it has to come from the heart. It can't just be an act to make others trust you.
Acting credible isn't the same as being honest.
Not at all. And he says his observation from decades in business was that those who rely on deceit often have initial rapid success. They're the ones achieving those great achievements for a little while.
But they don't last.
They eventually disappear and end up poor. Because trust, once you lose it with customers or suppliers, you never get it back. He concluded that the only common quality he saw among all successful, enduring people was integrity.
These principles of survival and integrity really shape his actual business strategy, especially his focus rule.
Right. He says business success is like high diving. The fewer moves, the better. You have to focus intensely on what you are truly good at. And that focus is enforced by a really disciplined stop doing list.
The stop doing list is the inverse of a mission statement. It defines your limits. What are some real examples?
Two great ones. First, a simple ethical rule. We do not accept orders from friends. This just prevents all sorts of conflicts and confusion.
Smart.
Second, a massive strategic decision at BBK. We do not do contract manufacturing or OEM.
Why reject that? That's a huge market.
Because they realized they could not beat Foxconn in that low-margin, high-volume game. They knew their strength was in branding and distribution, not pure manufacturing efficiency, so they focused entirely on their strength.
That discipline kept them safe.
It did. And that leads to this ancient saying he loves, Jinwei Kan Sheho.
Which means
Dare to be the last in the world. It's the anti-first mover strategy, and it's brilliant. You wait until a market is proven and large enough before you enter. This saves you all the costs of educating consumers and dealing with early tech problems.
he points out that none of the giants, Microsoft, the iPhone, Google Search, were the first movers.
None of them. They were second, third, or fourth, but they executed better once the market was confirmed. If a market is going to last 50 years, entering 5 years late is irrelevant, and it's way safer.
It shifts the risk from market creation to market execution.
Perfectly put. And all of this leads to his view on profit. Profit is a byproduct. If you focus on quality, user experience, and benfen, profit will eventually chase you. If you chase profit directly, he says, it runs faster than you can catch it.
So it's clear that money itself isn't his main driver. I mean, he was financially free decades ago. What fuels his continued engagement?
He views wealth as double trouble, but in a good way. He enjoys the intellectual process of earning it through principled investing. And then he enjoys the challenge of figuring out how to spend it on people he wants to help. The money is a complex problem he enjoys solving, not a destination.
And his philanthropy follows that same principle. Focus on what you understand.
Yes, his within-reach rule. He prefers to donate 90% of his foundation money to China-related causes or local community causes where he lives because he understands the context and can maximize the impact. He also started giving back way earlier than someone like Buffett or Gates. He didn't see the point in waiting until he was 70.
This focus on the process over the goal seems key to his whole life outlook.
It is. He realized this in college. The joy wasn't in achieving the goal. It was in the process of working toward it. So his ultimate life goal isn't some financial number. It's just to live healthily for a long time and enjoy every day doing what he loves.
And this rational, process-oriented view dictates how he handles mistakes.
Absolutely. His core rule for mistakes is, when you realize a path is wrong, stop immediately. No matter what it costs to correct an error right now, he argues, it will always be the smallest possible cost.
Because delaying just makes the problem compound.
Exponentially. He used the example of leaving his first successful job. It was painful, but he knew the company wasn't aligned with his long-term goals, and waiting would only make it harder to leave.
That's fantastic practical advice. But what about those tough choices where both options seem equally viable?
For those, his advice is to analyze them thoroughly, except you'll never have all the data, and then metaphorically close your eyes, pick one, and stick to it. The risk of being paralyzed by indecision is worse than picking the wrong path and failing.
Because failure won't ruin your life, but paralysis might.
Right. And finally, his views on luck. He basically dismisses it.
He calls it irrelevant.
Irrelevant to the strategy. His philosophy is, if you persist in doing the right things, integrity, rationality, safety, luck will eventually find you. He says people who fail just lack persistence. They give up too soon, always missing the moment when fortune finally arrives, usually during a period of panic, like with Nitties.
That persistence and principled conduct also show up in his views on parenting, which focus so heavily on emotional security.
This might be the most fundamental principle for his personal life. The most important thing a parent can give a child is a deep, unwavering sense of security.
Because a lack of security makes it hard to be rational later in life.
Exactly. It undermines the Ping Chung gene you need for success.
Yeah.
He says everything a parent does teaches the child. Yelling teaches yelling, hitting teaches violence. So you have to avoid actions that reduce security.
But he's clear that loving a child doesn't mean spoiling them.
Not at all. Principles and boundaries are absolutely necessary, but they have to be enforced without resorting to emotional distress or violence. Hitting might get you obedience based on fear, but it damages the child's long-term sense of security, which is the ultimate price. The goal is to raise rational adults, not just obedient children. #outro. So if we synthesize his entire worldview, the connection between his business life and his investing life, is just undeniable. His investment methods feature discounted cash flow, no borrowing, happily buying on the way down, are direct, logical extensions of his business principles.
Long-term survival, bend fin, safety over speed.
All of it. True mastery for him isn't about quick gains. It's about consistent, principled decision-making over decades and deliberately avoiding the fatal mistakes that take down faster, less disciplined competitors.
It all comes back to managing the whole game, not just one play. We talked about his analogy of investing being like golf. It's not about one brilliant drive, but the overall score you maintain over a lifetime. It's about minimizing errors.
Exactly. And this leads us to what might be his most profound strategic advice. Duan Yongping views his greatest success not as what he did, the companies he built or the stocks he bought, but what he chose not to do.
The stop doing list.
The rigorous, often painful discipline of the stop doing list. So we'll leave you with this question for your own life or career. If you applied that same principle, what are the 3 things you would stop doing immediately to ensure long-term healthy success?
Thank you for joining us on this deep dive into the philosophy of Duan Yongping. As a reminder, this analysis is based on publicly available sources and is for educational purposes only. It does not constitute investment advice.
Please conduct your own due diligence.
For additional resources and content on value investing, remember to check out the Deep Value Club membership and our related podcast channel, Deep Value Investing. And don't forget the recommendation noted earlier. You can track total market temperature by searching and downloading the iOS app Buffett Indicator from the Apple App Store. We'll catch you next time for the next deep dive.